It's the Real Estate Podcast, brought to you by ANZ Home Loans for financial well-beings.
Hey, welcome back to another episode of the Real Estate Breakfast, your largest real estate knowledge bank in Australia. Tell you what, if you can't find something that you need here, it probably doesn't exist. We are talking about your property from the Sunshine Coast to Canberra 7 days a week, so there is a lot of content there. And we are into a Wednesday morning, May the 21st. And good morning to Shane and Amanda in Docklands, Melbourne. You guys are busy saving to get into your first apartment there. Now, both of you are working main jobs and both of you have got part-time jobs each. You know, it never used to be like that. If two people previously had jobs and were saving for their first property, that was enough. But now it seems all too often with some of these emails coming through that people have got part-time jobs to supplement their savings. Now, you say, Shane and Amanda, that your saving feels never-ending, but you should be ready to pull the trigger to buy in October. How exciting. You say that you are doing it alone without any of your parents' help, and that you're also saving for a contingency amount of 5% on the property, which is, you say, around $30,000. And you've asked if anybody else is doing this. Well, I've got to tell you, we talk about buffers from time to time, but not a contingency based on the purchase price. So 30 grand, I just pulled up the median snapshot for unit prices there in Docklands, and the median price for units is $615,000. So 600,000, 5% is 30K. So I see where you're coming from. It is a great idea if you are in a position to do that, although I would say that the time to save that contingency versus the prices going up while you're doing that is an answer only you will know. Well, if you have got an answer perhaps along those lines, don't hesitate to get in touch. Our email address, myrealestatepodcast@gmail.com. And congratulations to both of you there, Shane and Amanda in Docklands. Let us know how you get on. Well, right now, let's go to Adelaide and catch up with Maddie Visser, who is there and a very busy mortgage broker. Good morning to you, Maddie. Welcome to the Real Estate Breakfast.
Good morning, Craig. Thank you for having me.
So what about that? Those two really busy bees, Shane and Amanda, that 5% contingency. Is that something you've heard of before?
Well, look, I think it's rare now. Currently, it's quite hard to save and then have a buffer on top. What I've seen in the past is we've had clients approved for more, but they've chosen to lend less, and that's been their buffer. However, you know, when they're talking about keeping a buffer in an offset facility, I think that comes from a lot of uncertainty in the market, what we've seen with interest rates. And now clients are wanting to hold those extra funds in case of emergency, whether it's an emergency for the property or whether it's a personal emergency. I am starting to see people want to hold a little bit of a buffer in their savings account or alternatively store it in their offset facility.
Yeah, it's interesting, isn't it? Because if you sort of look at this period of time where we are right now, oh, by the way, this is what happened yesterday.
Hot off the press and good news for existing mortgage holders and those trying to get in the market is that the RBA have cut the cash rate by 25 basis points from 4.10% to 3.85%. So that is good news. Not unexpected, but they've done it. Essentially, it's on the back of inflation coming back into target range of 2 to 3%. What does this mean? If you've got a mortgage of $750,000, you're going to save around about $125 a month. So that's good news for mortgage holders who've been through a lot of stress and strain over the last 12 to 18 months.
Would you agree that it's probably the conservative decision by the RBA, because many were maybe expecting that 50 basis points? Certainly mortgage holders were hoping that it might go as high as 50, but maybe a little conservative?
Oh, look, I don't think it was so much conservative as I think it's a measured decision. There's still some caution around inflation. There's some policies from the re-elected government that might stimulate some demand. Retail numbers are strong, consumer behaviour and confidence is growing. I think it's a good, measured, sensible decision on the back of where inflation sits, but also managing the potential risk of CPI climbing again.
So, yeah, that is what happened yesterday with the rate cut by the RBA. Yes, it's interesting, isn't it? Because if you look at this moment in time, Maddie, it can be argued that we're in a safe period of time, but we're not really, because we never know what is going to come out of left of centre. If you go back pre-COVID, nobody saw the COVID on the horizon and what was going to happen, and then as a result, all of the prices going bananas. So it can be argued, oh, well, this is kind of very, very safe, sort of getting a contingency budget. Is that required? But we have to say, well, let's err on the side of caution.
Well, that's correct, Craig. I mean, look, I think not everything is also about interest rates. I mean, the cost of living is high. There's uncertainty still from COVID. Having that buffer there, a lot of people can't achieve it. But if you can, I think, it's wise.
Yeah, and if we have a look at February earlier this year with that first interest rate cut, that gave the Australian housing market a short, sharp boost of sales. Home values lifted, particularly in Sydney and Melbourne, where high-income buyers reacted quickly. But as the other day, as Domain reported, that jolt of energy may not last, with affordability still strained, which is what you're talking about, and the cost of living pressures mounting. The market's underlying momentum still, I think, is still a little bit fragile, although yesterday's RBA cut, however, is likely to throw some more heat into the market. What do you think?
Absolutely, Craig. I think we're seeing a reawakening. People have been preparing like they did in February. They're preparing for rate cuts before they had even landed. But now, after yesterday's announcements, we're getting an influx. People they're ready, they're hungry, they're wanting to get back into the market. Pre-approvals are up, especially among second home buyers who may have sat out the uncertainty of last year. Refinances are also hungry for better rates and structure. This is creating an influx of interest in the market again.
Yeah, so what about the banks? Because it feels like the banks are being a little bit more competitive. They can see that, the worm has turned. Things are a little bit different. It's not post-COVID anymore. We're in a different dynamic, and the competition within the banks are heating up.
Well, that's correct, Craig. And I think if the lenders aren't passing on the discounts, a lot of consumers they're searching, so they're ready to refinance. They're not staying loyal to their lenders anymore, which we always encourage. NAB, Macquarie, Bank Australia, we saw them cutting their fixed rates before they had even announced the cash rate discount. So the lenders are getting prepared. They're ready. I can see them passing on this discount immediately that the RBA just announced yesterday.
What about the borrowing capacity and the clients that you are talking to? How much of the sitting on the fence, just waiting to see what the RBA yesterday was going to do, has that, do you think, for some of your clients been enough to look at that borrowing capacity and say, gee whiz, we can now actually finance ourselves into the property?
Absolutely. I think, for the discount could see repayments drop by $90 to $100 a month. I think for first home buyers, they may gain an extra $10,000 to $20,000 in borrowing capacity dependent on their income. Upgraders and investors could see $40,000 plus in borrowing capacity boosts. The demand is increasing. The only issue really is supply, and it is going to alternatively put pressures on prices, particularly in affordable family suburbs like lifestyle regions, for instance, in South Australia, the Adelaide Hills, Fleurieu Peninsula and outer north.
Yeah, because you're in one of those areas that has really surged since COVID. I mean, it all comes down to that increased borrowing capacity. And just on that note, we often talk about first home buyers. Sometimes a 25 basis point cut might not seem like a lot. But if you're buying in that upper echelon, if you're spending $2-3 million, that really stretches a hell of a lot, doesn't it?
Oh, that's correct. I mean, it's a difference of, being successful at an auction and not that extra, say, 40 plus K that you can achieve in the borrowing capacity can make all the difference.
Well, good luck for the 2025 year in South Australia. It is good news that the RBA has decided to once again cut the rate. Let's hope that you're busy there, Maddie, and that plenty of people are able to get into that first home.
Excellent. Thanks very much for having me, Craig.
Ready to take your real estate knowledge to the next level? So are we.
Yes, the question is, are the falling rates about to supercharge or even turbocharge the property market? It's always the same. There's either not enough or too much. It's feast or famine. So these interest rates, they're likely, of course, to be more as we progress through 2025. The Australians are at the moment upgrading, they're refinancing or they're buying that second property. So what do you think? Do you think that it's going to super turbocharge the property with these rate cuts?
I certainly do. I love how you said feast or famine, because I think it's definitely time to feast. People are just coming out in droves. Like, open for inspections currently, we're seeing 40 to 50 groups through, and properties are selling above the range. So buyers are definitely out in force. And if we see more rate cuts, there's only going to be more lending and more money and more people out in full force. So I think it's going to be a very interesting 12 to 24 months in real estate if we see those further cuts.
Yeah, and then on top of that, we've got the Trump craziness around the trade wars and whether that is actually going to help the Aussie mortgage holders. Now, there's a school of thought that the more crazy that it gets with these trade wars, that potentially the rate cuts could come down. I think there's also the potential that it could go the other way. I don't think it's an absolute given, because if it starts to affect the economy, who knows? But have you got a school of thought on that?
Whenever there's uncertainty in the worldwide economy, think back to COVID times, I guess there is that level of it could go either way. But for the most part, what we're hearing in the media, I think it's sounding pretty promising for purchases right now and with rate cuts and things like that.
Remember, we are not a real estate company. We are 100% all about increasing your awareness and knowledge for buying and selling properties.
Oh, absolutely. We sold a very small 3-bedroom in Botany, moved up here. We're found downsizers because we moved to a 5-bedroom, very expansive place with plenty of money still in the bank. So it was a good move.
Now, what have your other friends said about you moving into Port Macquarie? Are they jealous, envious, or are they saying, why did you do that?
Those friends came up every weekend in April. We had 4 sets of families for every weekend in April, just to, come up and taste the lifestyle, see the koalas that live in the trees next to our house. Most of our friends are a bit younger than us, so they're not quite envious yet, but I think when their time comes, they'll certainly consider it.
Having the Australian dream of buying a home, if someone's not able to do that in a larger city like Sydney, it's definitely worth exploring the option of maybe moving out a little bit further where you can purchase a property. There's lots of good jobs around Orange, and it's a really wide variety of employment opportunities.
We connect you to the best real estate information across Australia. The Real Estate Podcast.